Ali Hassan, Ambassador of Bahrain. I enjoyed your presentation. I have one question for Mr. Yamada and one question from Mr. Ikeda. Mr. Yamada, you said politics cannot predict. Somebody will say economics cannot predict. What your comment? The second question for Mr. Ikeda. You know, in physics and math, you measure distance or size, by meters or centimeters or kilometers. Before, you measure currency by gold. Okay? And this changed. Do you think this will come back to make the market more stable? Thank you, sir.
Okay, thank you, Ambassador. Very interesting question. But I think to answer your question, nothing is predictable. And that's why we sometimes resort to chart analysis, which is, in my view, most reliable in the financial market. But when we look at the economic performance, macroeconomic policy, fiscal policy, monetary policy, this year in 2016, very interesting way to look at what's been all happening is that monetary policy, fiscal policy, and the politics are basically forming trifecta, which means you see from the long-term political calendar, a double election is a strong probability, right? And if that is the case, consumption tax side delay is possible. It's a good theme for the election. But of course, the central bureaucracy wants to raise tax hike for a good reason, fiscal discipline. But everyone knows Abe administration's political capital is still very strong. So if they assume double election and delay in the consumption tax side, you can sort of see negative interest rate is another form of tax, right? So of course we cannot really predict, we couldn't predict negative interest rate introduction. And very, very hard to predict. But retrospectively, I think this year, what's going on in Japanese politics, fiscal policy, monetary policy, kind of all come together. And that's one of the reasons why we think the tax hike delay and double election is the chances increasing.
Okay, from my side, thank you very much for your very insightful question. It's very important to discuss whether the US dollar is a right gauge for any currency value, etc. Ideally, a currency without monetary policy is a kind of ideal gauge for relative value of any currency pairs. The problem of yen against the dollar is if dollar has a kind of a fundamental shift related to FOMC attitude, etc., the dollar yen will fluctuate, not just because of the yen size of the value. So gold is in that sense ideal because gold doesn't have any central bank. So there is no monetary policy, I would say, impact on gold. The problem around gold, however, is it will be affected by a real demand from industry-related demand for gold. So interestingly, in the last several days, in spite of the yen strengthening, gold has been fairly weakish, and this is partly because of the unwinding of bullish positions in commodities in general, which accumulated in the last several weeks. So US dollar is not perfect because of the noise around Federal Reserve monetary policy, but gold is also not a perfect measure to gauge any currency value because there will be impact from demand, real actual demand or industrial purpose demand for gold. So I think it's always better to compare any currency pairs to currency For example, I tend to compare Japanese yen not just against US dollar, but also Swiss franc, euro, or maybe gold, to know what's really having impact on the Japanese yen.
And anyway, it's quite amazing that in spite of Japan being the most indebted country relative to the GDP in OECD, in spite of continuous downgrading in the past years of the sovereign rating, in spite of delays in fiscal consolidation, in spite of the kamikaze monetary policy of Kuroda, so the yen still enjoys this status of safe haven currency to be bought in time of market turbulence. So do you think that this will continue, or in the future there will be not such an automatical run to buy yen in times of market turbulences?
So from my side, the reason why yen behave like a safe haven currency is coming from two different aspects. Of course, both of they are connected to each other though. First is Japanese institutions tend to buy more foreign assets when the risk sentiment is better. So when economic situation looks good or the stock market looks encouraging, Japanese institutions tend to buy more foreign currencies, which will weaken the Japanese yen. So that's one thing. The other thing is it's related to market mechanism. When the volatility is very low, investors tend to buy high-yielding currencies because in a low volatility world, you want to earn carry with long positions in high-yielding currencies, and you may want to fund in low interest rate or negative rate currencies. And therefore, in a risk-on sentiment or lower volatility, yen is a currency to be sold, while, for example, Australian dollar is a currency to be bought. And in a negative situation with higher volatility, there will be unwinding of those optimistic positions, long Aussie, short yen. That will mean buying back of Japanese yen. Therefore, in a negative sentiment, typically yen tends to strengthen. I think this is the mechanism why yen behaves like a safe haven currency.
And what are the technical reasons why it's almost automatic that when the yen weakens, the stock exchange, Japan Stock Exchange tend to go up, and especially I mean, when the yen tend to strengthen, the stock exchange tends to go down.
Japanese equity.
Yeah, Japanese equity.
Well,
it seems that it's almost automatic. I mean, in
right.
most cases, there is a strong negative correlation.
Yeah, I think part of the reason is explained by by Ikeda-san just now. Yen is a safe asset and ultimate funding currency in the world. If you look at banking statistics from 2000, it's only the Japanese banks who have been consistently lending to the world. After the financial crisis, US and European banks have reduced foreign exposure, but Japanese banks are the only aggressive lender, which means when you have risk aversion, of course, equity markets decline, and the funding currency will strengthen. And also internally in Japan, Japan is trying to exit deflation from years of deflation, and as a part of the national effort, the BOJ has been implementing aggressive monetary easing, which is negative for Japanese yen and positive for Japanese equity. At least investors do perceive this dynamics. So the positions are built on the assumptions that Japan will exit deflation on Japan's monetary policy and other policies. So when this reverses, naturally we see lower equity price in stronger Japanese yen.